Stop losing money, the secret to a profitable investing strategy. Welcome everyone. Thank you for joining today's educational webinar. Whether you're fresh out of college, starting your first job, or just curious about how to make your money work for you, you're in the right place. Investing may seem intimidating at first, but this guide will break everything down into straightforward, actionable insights. By the end of this video, you'll have the knowledge and confidence to begin your investment journey and build sustained wealth over time. Let's dive in. Let's start with the basics. Investing is the process of using your money to generate a profit or income over time. It's about putting your money to work for you, so you'll end up with more than you started with. Sounds simple, right? But why does it matter, especially for young investors like you? First, the earlier you start investing, the more time your money has to grow through compound interest. Albert Einstein once said, "Compound interest is the eighth wonder of the world." To put it simply, compound interest allows your investments to earn returns, and over time, those returns generate even more returns. Second, investing helps you outpace inflation. Inflation is the gradual increase in prices over time, reducing your money's purchasing power. By investing, you can grow your wealth at a rate that outpaces inflation, ensuring your money retains its value. Lastly, investing is the most accessible route toward financial independence, whether you're saving for a house, your child's education, or retiring early. The earlier you start building wealth, the more choices you'll have later in life. Before you start investing, it's essential to set clear goals. Ask yourself, why am I investing? Is it to save for a long-term goal, like retirement? Or do you have shorter-term targets, such as buying a car or traveling extensively in a few years? Here's how you can set and prioritize your financial goals. Short-term goals. These are goals you want to achieve within 1-3 years. For example, creating an emergency fund that covers 3-6 months' worth of expenses. Medium-term goals. These involve plans that are 3-10 years away, like saving for a down payment on a house or your wedding. Long-term goals. These are typically goals 10 or more years away, like retirement or achieving financial independence. Once you've identified your goals, prioritize them. Some goals, like having an emergency fund, should take precedence over others. Prioritization will determine your investment strategy and risk tolerance. One of the most crucial principles in investing is the relationship between risk and reward. Simply put, the higher the potential reward, the higher the risk you're likely to face. Low-risk investments. Examples include savings accounts and bonds. These offer stable, predictable returns but tend to grow your wealth slowly. Moderate risk investments. Think blue-chip stocks or index funds. These offer a good balance between risk and growth potential. High-risk investments. These include individual stocks in volatile sectors, like tech startups or cryptocurrencies. While the potential rewards are high, there's also a significant chance of losing money. The key takeaway: your risk tolerance depends on your age, financial goals, and personality. Younger investors often have a higher risk tolerance because they have more time to recover from any losses. Let's revisit compound interest because it plays a massive role in successful investing. Here's a simple example. Imagine you invest $1,000 at an annual return rate of 8%. After the first year, you'll have $1,080. By the second year, your 8% return will be calculated on $1,080, not just the original $1,000. This simple principle means your money grows faster the longer it stays invested. Starting early gives you an undeniable advantage. For instance, if you invest $100 a month starting at age 22 and earn an average return of 8%, you'll have around $350,000 by age 62. Delay starting until you're 32, you'll only have around $150,000 by age 62, less than half the amount, even though you invested for just 10 fewer years. The key lesson? Time in the market is far more critical than timing the market. As a young investor, it can be overwhelming to decide where to put your money. Let's break down the most common investment vehicles. Stocks. When you buy a stock, you're buying part of a company. Stocks have the potential for high returns, but also come with higher risk. Bonds. Bonds are essentially loans you give to governments or companies in exchange for interest. They're less volatile than stocks, but usually offer lower returns. Mutual funds. These are professionally managed investment funds that pool money from multiple investors to invest in a diversified portfolio of stocks or bonds. Index funds and ETFs. These track a market index like the S&P 500. They are low-cost, diversified, and ideal for beginners. Real estate. This involves buying property to generate rental income or sell at a higher price in the future. Cryptocurrency. Digital currencies like Bitcoin and Ethereum can offer high returns but come with extreme volatility. Be cautious, especially as a beginner. The best approach? Diversify your investments across different vehicles to reduce risk and increase returns over time. Now that we know about various investment vehicles, let's create a basic investment portfolio. A common rule of thumb is to use your age to guide your asset allocation. For example, subtract your age from 100 or 110. The resulting number indicates the percentage of your portfolio that should be in stocks. If you're 25, you could allocate 75 to 85% to stocks, and the rest to bonds or other low-risk assets. Another option is the 60-40th rule, which suggests allocating 60% of your money to stocks and 40% to bonds. This is a conservative strategy suitable for new investors. Above all, keep it simple when starting. Consider investing in a diversified index fund, which automatically spreads your money across many stocks in different industries. Success in investing depends on consistency. Here are 3 strategies young investors should adopt. Pay yourself. First, treat investing as a non-negotiable monthly expense. Automate transfers to your investment account as soon as your paycheck arrives. Dollar cost averaging, DCA. Instead of trying to time the market, invest a fixed amount at regular intervals. This approach averages out the cost of investments and reduces the impact of market fluctuations. Reinvest your earnings. If you earn dividends or interest, reinvest that money to accelerate your portfolio's growth. As a beginner, it's natural to make mistakes, but being aware of them can save you a lot of stress. Here are some mistakes to avoid. Impulsive decisions. Emotional reactions to market fluctuations often lead to poor decisions. Avoid panic selling or buying based on hype. Overtrading. Frequent trading incurs high fees and disrupts the long-term compounding effect. Lack of research. Always understand what you're investing in. Blindly following trends or advice can be risky. Ignoring fees. Hidden fees, such as high expense ratios in mutual funds, can significantly eat into your returns over time. Not diversifying. Putting all your money in one stock sector or asset class increases your risk. Spread your investments for stability. If all of this still feels overwhelming, good news, you don't have to do it alone. Financial advisors can guide you through the investing process, helping you create and stick to a plan. However, ensure you choose a fiduciary advisor, someone who is legally obligated to act in your best interests. Robo-Advisors are also a great low-cost alternative for beginners. These automated platforms design and manage a portfolio for you based on your goals and risk tolerance. Successful investing requires patience. Markets will fluctuate, sometimes dramatically, but the history of the stock market shows that it grows over long periods. Don't let short-term market dips scare you. The S&P 500, for example, has consistently provided an average annual return of about 8 to 10% over the past century. Hold on to the mantra, time in the market beats timing the market. Finally, investing is just one piece of the puzzle. Along with building wealth, you must also protect it. Here's how. Maintain an emergency fund for unexpected expenses. Diversify your investments to shield yourself from severe losses in one area. Review your investment goals periodically to ensure they align with your changing life circumstances. Congratulations, you've taken an essential step by educating yourself about investing. Remember, the most critical factor in building wealth is starting as early as possible. Regardless of how much money you begin with, the key is consistency. Invest wisely, stay disciplined, and don't be afraid of making small mistakes along the way. Every dollar you invest today lays the foundation for the financial freedom you'll enjoy tomorrow. Thank you for being part of this webinar. We hope you feel empowered and excited to begin your investing journey. If you have additional questions, feel free to reach out. The future is yours. Take charge of it today.